All right, welcome to The Explainer. I am so pumped you're joining us today because we are looking at what has to be one of the most explosive financial maneuvers happening in the market right now. GameStop is dropping what can really only be described as a financial nuke on Wall Street. We're talking about a massive restructuring playbook that involves aggressive debt elimination, a historically huge takeover attempt, and a stock that is just swinging wildly as the market tries to price in what exactly is going on. Is this a masterstroke of corporate strategy or, a desperate gamble? We're going to break down every verified detail step by step using the actual data. $56 billion. Let that number sink in for a second. That is the size of the takeover bid GameStop recently launched for the e-commerce giant eBay. It's an absolutely astronomical figure that has left analysts completely stunned. Now, this bid was rejected by eBay's board, but the story definitely doesn't end there. GameStop is aggressively positioning itself to keep pursuing this absolute elephant of a deal. And to understand how a legacy video game retailer can even attempt a $56 billion buyout, we really have to look at the financial engine powering the whole move. And that engine is represented by another massive number, $1.4 billion. This is that financial nuke I mentioned earlier. GameStop isn't just taking on massive new loans to fund their ambitions. Actually, they're executing a colossal $1.4 billion debt for equity swap. It's literally the core mechanic that makes the entire eBay takeover attempt even possible. Part 1. The mechanic, unpacking the debt swap. Okay, let's dive into this and look at how GameStop is re-engineering its entire balance sheet. So, skipping all the wild internet rumors, let's go straight to the source. On August 3, 2026, GameStop formally filed an 8K with the SEC. This definitive agreement isn't speculation, right? It's real, binding paperwork. The filing confirms that GameStop is exchanging roughly $1.4 billion in convertible senior notes, which, by the way, were originally maturing in 2027, for newly issued shares of common stock at a fixed conversion rate. Now, just to make sure we're all on the exact same page, let's clearly define what a debt for equity conversion actually is. It's basically exactly what it sounds like. A company wipes out the money it owes, its debt, and pays back its creditors by creating and handing over newly issued shares of its own stock. So the creditors, in this case the bondholders, are trading their guaranteed debt repayment for an actual ownership stake in the company. They're betting the stock goes up. GameStop, on the flip side, is betting that freeing themselves from this massive debt anchor is going to allow their operational turnaround to just accelerate. And this brilliantly illustrates the exact trade-off GameStop's management is wrestling with. On the upside, they wipe $1.4 billion of debt completely clean off their books. Because they no longer have to service that debt, they instantly save roughly $80 to $100 million in annual interest payments. That is pure, unadulterated cash flow freed up. But, of course, there's a downside. To pay off that debt, they have to create approximately 73 million new shares. This dilutes the existing shareholder pool, bringing the total outstanding shares up to around 306 million. If you own a slice of the pie, well, your slice just got a little bit smaller. It's the ultimate balancing act between a fortified balance sheet and shareholder dilution. But the immediate, undeniable result of this swap is this staggering figure, roughly $4.6 billion. By eliminating their debt and saving on those massive interest payments, GameStop's post-swap cash position just balloons. They are sitting on a veritable war chest of $4.6 billion in pure cash. And as we all know, cash flow and liquidity are exactly what you need if you're gearing up to make a market-shaking acquisition. Now, what's really interesting here is how GameStop is actively signaling confidence to the broader market. At the exact same time they announced the debt swap, they reaffirmed their guidance of $600 million in adjusted EBITDA for fiscal year 2026. This is actual projected operating profit. We're not talking about meme hype. This is a fundamental business metric. By reaffirming this number, GameStop is basically telling Wall Street, hey, our core turnaround strategy is working and we are generating real profit. This is the foundational strength they believe justifies their aggressive next steps. Which brings us to part 2. The motive. The eBay gambit. Why amass this massive war chest right now? Well, it all leads straight back to CEO Ryan Cohen and his unbelievably ambitious target. The goal isn't just to be a mall video game retailer anymore. Cohen's vision is to fundamentally merge the rapidly growing collectibles ecosystem with eBay's massive established e-commerce marketplace. Think about it for a second. PSA card grading, rare sneakers, vintage video games, all centralized under one massive digital roof. It is a brilliant, aggressive play to control the entire secondary market for physical pop culture assets. And they aren't just talking about it, they are aggressively pursuing it.
GameStop has already quietly amassed a 9.8% stake in eBay. That's about 43.4 million shares. They actually leveraged that exact position to make the $56 billion takeover bid we talked about earlier. And even though eBay's board rejected it, Cohen is relentless. He is reportedly foregoing his own executive compensation package entirely just to focus all his energy on making this deal happen. He's personally absorbing the financial sacrifice to see this vision realized.
Part 3. The market's reaction, making sense of the volatility. Let's look at how investors are handling all this. Spoiler alert! The initial reaction was total fear. The moment that 8K was filed, GameStop's stock price took a sharp pre-market dive right down to $19.59. Why? Because institutional and retail investors alike saw the math on those 73 million new shares. The fear of immediate dilution grabbed hold way before the broader strategy of the eBay takeover could be fully digested by the market. So right now, we basically have 3 competing narratives driving the wild volatility we're seeing on the charts, and we really need to understand all of them. First, the bear case. Dilution is never popular. More shares literally equal lower earnings per share. If the eBay deal completely falls through, bears argue GameStop just gave away equity for absolutely nothing. Second, the bull case. Debt reduction is inherently smart, right? If they actually acquire eBay, GameStop becomes a $60 billion plus e-commerce titan overnight. The upside is astronomical. And finally, the meme factor. Retail traders are watching every single tick. Short interest on the stock is still elevated, so any whisper of positive news could trigger a massive short squeeze, completely divorcing the stock price from traditional fundamentals. But amidst all this chaos, there is a fascinating safety net buried in the fine print. As this quote from the SEC filing shows, GameStop retains the right to redeem any remaining notes for cash if certain conditions are met. This is a strategic escape hatch. It means if the stock price drops too low or if the market conditions become completely unfavorable for the swap, GameStop isn't locked into diluting their shares to death. They can pivot and pay out the remainder in cash, utilizing that $0.6 billion reserve. It adds a really critical layer of safety to an otherwise incredibly risky gamble. Let's move to part 4, the future outcomes, 3 paths forward, and see how this all builds into realistic scenarios. Let's quickly walk through the mechanics of each. Path 1, the acquisition succeeds. Cohen forces a deal with eBay, GameStop likely issues even more shares or takes on new debt to fund the massive purchase. The stock could absolutely double or triple on the euphoria, but the company immediately takes on enormous operational integration risk. Path 2, the acquisition fails. The eBay board holds firm, the bid falls apart. GameStop is left with a remarkably clean balance sheet, but no immediate hypergrowth catalyst. The stock likely settles into a standard trading range as the turnaround continues organically. And path 3, the short squeeze. Retail investors rally hard behind the sheer ambition of the news, short sellers are forced to scramble and cover, and we see a 2021-style price spike. However, given the higher number of outstanding shares post-dilution, this spike would probably be shorter and smaller than historical squeezes. If we take a step back and objectively weigh those first 2 fundamental business outcomes against each other, we see a really stark contrast. Path 1 is Cohen's ultimate long-term play, creating a dominant, unified collectibles marketplace. It carries the absolute highest risk and the highest reward. Path 2, however, is arguably the most likely short-term scenario. A failed bid still leaves GameStop with slashed interest payments, a clean balance sheet, and steady organic growth, with the stock likely settling in the $15 to $20 range. It's not as flashy for sure, but it represents a fundamentally healthy business. So what should you actually take away from all this? Well, if you're tracking this situation, ignore the noise and follow the paperwork. The practical application of everything we've just covered is to monitor the official SEC filings and GameStop's investor relations page closely over the next 30 days. That is exactly where the definitive agreements, the revised bids, or the cancellation notices are going to appear first. The data will tell the story way before the rumor mill ever does. So think about it. GameStop is trading debt for equity, gambling on a colossal acquisition, and heavily betting that their operating turnaround is essentially bulletproof. It is a textbook high-risk, high-reward strategy playing out right before our eyes. Ryan Cohen is putting his entire reputation on the line to transform a legacy retailer into a modern e-commerce behemoth. Is this the work of a visionary genius perfectly timing a massive market disruption, or is it a desperate, overly complex gambit to mask a stalling core business? The mechanics are in place, the cash is ready, and the market is waiting. Thank you so much for joining me on this deep dive. Keep your eyes on the filings because this story is just getting started.